Trump's decision to impose a 25% tariff directly targeting Japanese automakers has sent shockwaves through the industry. Overnight, 500,000 jobs in the United States were thrown into uncertainty, and more than $170 billion in auto sales are at risk of evaporating.
A political earthquake shook the global auto market overnight when former President Trump announced a 25% tariff squarely aimed at Japanese automakers. Toyota, Honda, and their sprawling U.S. supply chains suddenly find themselves staring down a trade wall of historic proportions. Nearly 500,000 American jobs now hang in limbo, and more than $170 billion in annual U.S. auto sales is at risk of evaporating. The White House frames this as a matter of national security, but on factory floors and dealership lots, the true impact is measured in soaring car prices, shrinking tax revenues, and the specter of a supply chain breakdown that could spread far beyond Detroit. What looks like mere statistics on the spreadsheet, percentages, billions of dollars, basis points, could soon become hardship for entire communities. Every uptick in tariffs threatens to drag factories, dealerships, and small-town economies into a cycle of layoffs and lost income. The real question is whether America's auto heartland can withstand this economic quake, or whether Detroit will be forced to relive the painful factory closures of decades past. And behind these headline figures lurk powerful actors, financial players, and global creditors who stand to profit quietly from the chaos. To understand the stakes for Toyota and Honda, one must look beyond assembly lines to the financial leverage Japan holds over Washington. As of February 2025, Tokyo owned a staggering $1.13 trillion in U.S. Treasury securities, making it America's single largest foreign creditor. That's more than 12% of all foreign-held U.S. public debt, an economic sword hanging over the bond market. On May 2nd, Japan's finance minister publicly hinted that this vast reserve could be used as a bargaining chip in trade talks with the Trump administration. An unusually direct warning timed just weeks after a market sell-off that rattled investors. The new 25% tariff, scheduled to take effect August 1, 2025, doesn't just target cars and parts. It strikes at the very nerve center of U.S. finance. Even a modest sell-off of U.S. Treasuries by Japan could send bond yields soaring, pushing up mortgage rates, credit card interest, and business borrowing costs across America. Policymakers know this, which is why every tariff announcement now doubles as a high-stakes signal to bond traders. A single move by Tokyo could transform a trade dispute into a nationwide cost-of-living surge. Faced with this dual threat of tariffs and bond volatility, Toyota and Honda have begun reshaping their entire production networks. Plants in Mexico, Thailand, and Southeast Asia are being expanded or repurposed as the companies hedge against an American market suddenly fraught with risk. These aren't mere efficiency tweaks. They're systemic shifts that could permanently alter global auto production, leaving U.S. workers exposed to layoffs and wage stagnation even if car prices climb. Financial markets have already shown how sensitive they are to every twist in this saga. In April 2025 alone, fears of a Japanese Treasury sell-off pushed 10-year U.S. bond yields by as much as 70 basis points in a single week, the sharpest spike since the COVID era. A rise of just 30 to 45 basis points could lift the average American mortgage rate from 4.5% to nearly 5%, adding hundreds of dollars to monthly payments for new homeowners while driving up the cost of auto loans, student debt, and corporate financing. What began as a tariff threat has morphed into a full-blown financial storm. If Japan were to release even a small fraction, say 5% of its treasury holdings, roughly $56 billion, the move could overwhelm weekly treasury auctions and jolt global capital flows. Emerging markets would face sudden outflows, currency rates could swing wildly, and U.S. businesses planning expansions might be forced to shelve investment projects. What's unfolding is not just a trade dispute, but a monetary confrontation where treasury bonds themselves become the battlefield. The economic tension is now testing the US-Japan alliance in ways unseen for decades. Japanese leaders have expressed deep regret over the tariffs while warning that all options remain on the table. The yen has already strengthened sharply, eroding the competitiveness of US exports and giving Tokyo yet another tool to apply pressure. Even a modest currency move can raise import costs for American automakers and complicate supply chain logistics, proof that this clash reaches far beyond car dealerships into the realm of global monetary power. By late June 2025, the consequences became unavoidable. Toyota and Honda announced the closure of several U.S. plants, redirecting assembly lines to Mexico and Southeast Asia. This isn't just a tactic to dodge tariffs. It's an escape route from an economy where trade policy and bond market volatility now dictate business survival. For American workers, the impact is painfully concrete: lost jobs, heavier household debt, and rising loan payments, even as car prices continue to climb. The 25% tariff is no longer a talking point. It's a live test of economic strategy. Every Treasury auction, every White House statement, and every yen-dollar fluctuation could ignite new volatility. Washington must decide whether this gamble will secure a stronger bargaining position or trigger a self-inflicted recession. The world is watching to see if America doubles down or retreats, and whether this bold move proves to be a masterstroke of trade diplomacy or a reckless bet that backfires. The tremors from this US-Japan standoff are not confined to Detroit or Tokyo. European automakers, Asian suppliers, and Wall Street investors are all bracing for collateral damage. German luxury brands fear retaliatory tariffs could spill into EU markets, while South Korean and Chinese suppliers watch nervously as supply chains grow more fragile. Hedge funds are already positioning for currency swings and bond sell-offs, treating every Trump press conference and every Japanese finance ministry statement as a market-moving event. What began as a tariff fight over cars is now a global financial spectacle, with traders from Frankfurt to Hong Kong calculating their next move in real time. At stake is more than just the price of cars or the health of the bond market. It's the future architecture of international trade and monetary power. If Japan wields its treasury holdings as leverage and the US refuses to back down, this conflict could rewrite the rules of global finance. Central banks from Europe to Asia are quietly revising contingency plans in case the dollar's status as the ultimate safe haven is called into question. For everyday Americans, this means higher borrowing costs, pricier imports, and a financial landscape where politics, not economics, dictates the cost of living. The next few months may determine whether this is a short-lived showdown or the opening chapter of a new era in economic warfare.